Happy Monday, everybody. I hope you had a great weekend. Today is February 3rd, 2025, and this is your Monday market update. We continue to see record moves. First, over 57 new S&P 500 highs for 2024. The highest was 1998, but last year was obviously one of the big ones. This one, maybe not for the record books, but Netflix moved last week up 14% in one day. And last Monday, when due to some news we'll talk about in a minute with DeepSeek from China, took not just the wind out of NVIDIA sales, but the largest one-day drop in market cap history. NVIDIA alone lost nearly $600 billion in market cap. Now let's review what happened last week in the market. On Monday, the U.S. stock market experienced significant volatility, primarily driven by developments in AI, of course. The Dow was positive on the day, but the NASDAQ and S&P did not fare as well. The downturn in the S&P 500 and the NASDAQ was primarily driven by a sharp sell-off, of course, in technology stocks. As I mentioned, NVIDIA, for instance, experienced a nearly 17% decline in its share price. This was largely due to concerns over emerging competition from China's DeepSeek, which announced the development of a large language model capable of rivaling those from the U.S., the tech giants here, potentially at a fraction of the cost. Despite the challenges faced by the technology sector, industrials outside of the AI-related fields demonstrated resilience, contributing to the Dow's positive performance for the day. In summary, while the Dow Jones Industrial Average did benefit from gains in non-tech sectors, the S&P 500 and the NASDAQ were adversely affected by significant declines in technology stocks, particularly from those related to artificial intelligence. The Dow was up 0.75%, S&P 500 down 1.5%, and the NASDAQ was down over 3%. Tuesday brought some relief. Stocks rebounded from Monday's AI-driven losses, helped by a mix of Goldilocks economic data and technical buying after the sell-off. DeepSeek AI concerns were digested by the markets, with some investors seeing the drop as an overreaction to the news. Earnings from Microsoft, Meta, and Tesla were highly anticipated, with traders positioning ahead of those reports. Bond yields remained stable, the 10-year Treasury about 4.5%, helping growth stocks recover. Dow was up 1/3%, the S&P up almost 1%, and the NASDAQ up 1.33%. Wednesday, of course, was Fed Day, and there was enough excitement to go around. Volatility spiked as the Fed signaled fewer rate cuts. The Federal Reserve kept rates unchanged as expected, but removed language about the, quote, further progress on inflation, close quote, causing a hawkish market reaction. Markets dropped sharply following the announcement as the investors pushed back expectations for the next Fed rate cut. Tariff uncertainty grew as the Trump administration hinted that new restrictions on NVIDIA chip sales to China. Growth stocks led the decline, with Microsoft sliding over 4% post-earnings, though Tesla and Meta provided some stability with better-than-expected results. The U.S. dollar strengthened again, reflecting the Fed's tone, while bond yields ticked higher, with the 10-year yield climbing to 4.55%. The Dow ended the day down 1/3%, the S&P down 0.5%, and the NASDAQ was down about 1.25%. Thursday brought tech earnings to spark a rebound as Fed uncertainty lingers. Stocks rallied early Thursday as positive earnings from Tesla, Meta, and IBM helped to offset Microsoft's sluggish guidance. GDP data showed a slowdown in Q4 growth at 2.3% versus expectations of 2.6%, but strong consumer spending eased concerns. Treasury yields did fall as bond markets doubted the Fed's ability to hold rates steady for much longer, with the 10-year yield retreating to 4.52%. The Dow closed the day up 1/3%, S&P up 0.5%, the NASDAQ up 0.75%. Markets opened higher on Friday. The PCE, that Personal Consumption Expenditures Price Index, rose 0.3% in December, matching estimates. The Fed's preferred inflation gauge, that's it, also rose 2.6% on an annualized basis, though that was an acceleration from the prior month's 2.4% advance. This was in line and not such a surprise. Recall, this is still trying to get to that 2% the Fed wants. Not there yet. Apple and Intel beat their earnings, both up. Chevron missed theirs, and it was down. Notable was that Chevron used the term Gulf of America in their reports. Just saying. We did get Fed head Goolsbee speaking that he sees progress on inflation, but he did note the risk of what happens on the tariff front. This all remains to be seen. We'll talk about that in just a second. During Friday's session, 21 stocks in the S&P 500 traded at new 52-week highs. Of these, 17 reached all-time highs. Later in the day, word from the White House was that about the 25% tariffs were on the way. Word was 25% on Mexico and Canada, 10% on China. All remains to be seen. Again, we'll talk about that in just a moment. Markets did not like that, as you know. They did not wait to see. Later in the day, selling came in on that news. Autos up early in the day turned red as they expected a big tariff hit. Another note: the year of the snake. That's has been the worst performing zodiac cycle for the S&P 500, averaging a 2% decline since 1930. The data showed that the Chinese zodiac rotates through the 12 animals. The year of the snake started last week. Research keeps coming up on the main issues facing this market. We had calls for 3 rate cuts still this week. Also, that the DeepSeek risk is overblown. UBS even restated their positive feel on the AI trade. At the end of the day, Friday, the Dow was down 0.75%, S&P down 0.5%, the Nasdaq down 0.25%. For the week, the Dow finished 1/3 of 1% lower, S&P down 1%, and after tumbling over 3% on Monday, the Nasdaq Composite ended Friday with a weekly loss of 1.5%. Not to leave this out, Nvidia, which plunged nearly 17% on Monday, up and down all week, posted a weekly loss of roughly 16%. Let's look ahead into this week. We're going to watch for some keys. Does Powell or the Fed head parade start walking back the hawkish mood from last week? We're going to hear from a long list of Fed heads this week: Bostic, Musalem, Daly, Raphael, Jefferson, Barkin, Goolsby, Bowman, Waller, Logan, and Kugler. We also will continue to get big earnings, and recall that I am focused on growth and thus valuations. Google's parent Alphabet's coming, Amazon, Merck, Pepsi, AMD, Palantir, Disney, Uber, Lilly, and more. If growth slows, we have more to worry about. So far, I have to say, it seems to be holding its own. This week, we're going to see more. What we are seeing as the next shot, of course, fired on tariffs. As of this morning, it looks like the market's going to react negatively to the recent tariff news. We'll see what lasts longer, either the tariffs or the reaction. Of course, eco data. I'd like to watch some of the obscure data, but telling data. Today, we're going to get the Senior Loan Officers Opinion Survey. This helps to know a little bit about the lending that it looks like, and that can be telling. Of course, also, this is the first week of the month, Jobs Week, and that will follow some other important data that the Fed is watching. Watch for JOLTS tomorrow, ADP Wednesday, jobless and continuing claims on Thursday, and then the big one of the week, for non-farm payrolls on Friday. This will be one of the key sets of data that the Fed's going to continue to point to. We're going to close out the week with the University of Michigan surveys, sentiment, and inflation expectations. All right, last week's action highlighted the market's fragility in the face of AI-driven disruption, shifting Fed expectations, and economic uncertainty. While growth stocks did struggle, defensive and value sectors provided stability, reinforcing the need for diversification. With Fed uncertainty and key earnings ahead, market volatility is likely to remain high, making it critical to stay nimble and focus on broader market trends beyond short-term swings. Keep in touch with how all of this fits in your plan and what changes you may need to make. I continue to do risk audits for your overall situation. This can include your employer retirement plans. Again, please ask me how to do that. For now, have a great weekend and stay in touch.